Welcome to Trader TV, your insight into trading for professional investors. I'm Dan Barnes. Portfolio trading in the fixed income markets has evolved immensely over the past 18 months. Joining me today is Ted Husveth, Managing Director for US Credit at Tradeweb Markets. We're going to be discussing how they have seen changes in the market, changes in the way portfolio trading is used, and an expansion into different geographies. Ted, welcome to the show.
Hi, Dan. Thanks so much for having me.
No problem. So tell us, if we're looking at the different dimensions of execution quality, what makes portfolio trading so interesting and exciting right now?
When clients talk about execution quality, traditionally, they're talking about basis points. How many basis points am I paying from mid or from bid to get a trade done?
Yeah.
What portfolio trading has really opened up in the buy side's mindset is an extra dimension of execution quality. And it's how much of what I need to get done today am I getting done today?
That's excellent. So how do you see clients using portfolio trading at the moment? And is that changing, in terms of geography, in terms of the way they engage with it?
Portfolio trading really started in investment grade and high yield in the US. As the dealer community has started to invest in portfolio trading, we've seen that same playbook that played out in the US start to play out in Europe, where portfolio trading has grown tremendously over the last few years. 3-4 years ago, portfolio trading really wasn't a thing in Europe. And now we're seeing billions a week trade just on our platform in portfolio trading. And another place that it's grown is in emerging markets and in global emerging markets portfolios. So we're seeing more and more EM investors looking to engage, more and more EM market making desks looking to build up their capabilities for portfolio trading.
Are there different use cases for it, depending upon types of clients and types of portfolio?
You could think of just the asset managers or insurance companies that are using portfolio trading maybe once a month, maybe once a quarter to do large rebalances. So that might be $1 billion plus of a portfolio that they're doing pretty infrequently. We have some other clients that are using portfolio trading, several times a week, sometimes several times a day. In some respects, replacing some of the RFQ or supplementing some of the RFQ flow that they've seen. We see more and more hedge funds coming into the space, particularly long short hedge funds that are using portfolio trades as a way to package what they're looking to do that particular day and really get one execution point for their entire strategy.
Are there any surprising elements of how portfolio trading is being used?
When we originally launched our portfolio trading protocol, we envisioned it as a solution to a really specific trade that was happening at the time. We thought we were streamlining a process that was really spreadsheet based, where large asset managers were doing block size trades with a handful of liquidity providers that were really connected to the ETF ecosystem. But since we've launched, we're continuing to see the use cases for this tool to evolve from the buy-side perspective. We're seeing some portfolios having a mix of IG, high yield, emerging markets bonds in them. And more, we're hearing it from the dealer community and the buy side that they want to see more and more potential asset classes added to what could be traded as a portfolio trade. So we only see this growing.
And how would you define the advantages of portfolio trading for an asset manager?
The most important thing to our clients is that they're getting everything done that they need to get done in a timely manner.
Yeah.
So we are seeing some portfolio trades that are 500, 800 line items getting done within a half an hour to an hour. Typically, historically, that might take a day or two, several traders working on. Now it's all being packaged as one portfolio. So the timeliness of getting everything done. And then the second major advantage of portfolio trading is, like, if you're talking about a portfolio that has that many line items, how am I tracking what I'm paying to get that done? And so at the forefront of the portfolio trade is the aggregate level statistics, whether that's a yield bogey you're looking to hit or a proceeds bogey. And you can look at that versus where you're marked or where you think you should be able to trade in real time and look at your execution costs in real time as you're executing.
So there's a huge range of markets. There's a growing number of asset classes included. If a firm wants to get started with portfolio trading right now, what do you think they should do?
I think an easy first step would be to talk to Tradeweb. Multiple hundreds of users have been using our portfolio trading protocol for a couple of years. We can advise on what the best practices out there, how people are looking at TCA, and answer whatever questions they might have.
That's great. Ted, thanks so much.
Thank you, Dan.
I'd like to thank Ted for his insights today, and of course you for watching. To catch up on our other shows or to subscribe to our newsletter, go to tradertv.net. you.